Hi, I'm Tracy Soffra and welcome to the Women of Wealth podcast, dedicated to helping women achieve financial independence in every area of her life. Today I'm talking about my favourite subject, tax, of course. Why? Well, I started my career some 35, I think, years ago as an accountant. And so I'm very comfortable with taxation as I was a tax accountant in a private practice. And really, I mean, part of being a tax accountant, it transfers across to any financial planning type of study as well. So it goes hand in hand. So we are rapidly approaching 30 June and I thought I might touch base on how to maximise your tax return in terms of tax refunds. Now, it is that time to review the strategies that you can use to pay less personal tax. And who doesn't want to pay less tax, yeah? Imagine what you could do with the saved money. You could reduce your home loan, you could top up your super, you could save it for a holiday. You could have put it towards a deposit for an investment property, maybe upgrade the car if you need, kids' education. There is an abundance of places to put extra cash, isn't there? But the most important thing to remember is that there's no point in spending money to get a tax deduction. So what I mean by that is we don't just spend money for the sake of a tax deductibility point of view. It's got to make sense, yeah? Otherwise, you're sort of throwing money out. It's got to make sense and it's got to result in something that's beneficial to you, particularly from a wealth perspective, or if it's something that you absolutely need within your profession or your business. It is a good time to be thinking about all of this, planning your taxation position before 30 June, any given financial year. So I'm going to share with you some of the strategies that you can use to pay less personal tax. But what I want to first do is break down the components of your tax return so it's easy to understand how your tax liability is calculated and whether you're going to get a refund or whether you're going to end up paying tax. So the three main components of your tax return are these: assessable income, allowable deductions, taxable income. Now, taxable income is what you're paying tax on, so at marginal rate. So that's pretty important. So how is income tax assessed and calculated? Allowable deductions, assessable income, less allowable deductions equals taxable income. So income less expenses, that's your taxable income. And your taxable income, depending on how much that is, will then depend on what tax you're going to pay. For anyone, going off the top of my head at the moment, anyone between $45,000 to $135,000, I believe, is in the 30-cent tax bracket, plus 2% for Medicare, so you're at 32 cents in the dollar. And so what's important to note is those three components. So let me start with what is assessable income. Assessable means income that is assessed by the tax office. So employment income. When you're employed, you get a group certificate, and so that's assessable income. Any super pensions or annuities that you may be receiving. Any government payments that may be taxable. Any investment income. What's investment income? Interest on bank accounts, dividends from shares, any returns on any particular investments, they're assessable. Business, partnership and trust income, that is assessable income to you. So you might be in a partnership and the profit of that partnership is split between two people. Half of it goes into your income tax return. So if you're in a business and you're working somewhere, you're going to have a group certificate from work. You're going to have half of the profit from if it's a partnership, from the business coming in. It's all accumulating together. And any foreign income. As Australian residents, we are assessed on all forms of income, domestic and overseas. That's all got to go in your tax return when you think about assessable income. All of those things have to come into that. Now, the name of the game is to reduce the assessable income by maximising allowable deductions, because the difference between the two, again, remember, is called taxable income, and that's what you pay tax on, okay? So what are allowable deductions? Allowable deductions, let me explain it this way. there has to be a direct nexus between the expense incurred and the income earned. So if you can't just claim any old expense if you haven't earned any income to incur that expense. There's got to be a direct connection between the two. So maximising your deductions to reduce your taxable income, that is what we're paying tax on, is the important thing here. Here's a summary of allowable deductions. I'm going to break this down individually as well so it's easier for you to understand. So work-related expenses are allowable deductions. Cost of managing your tax affairs, pretty much your accounting fees, any gifts and donations, any interest, dividend and other investment income deductions. So, for example, to receive interest on a bank account that's fully accessible, are there any bank charges, subscriptions to any investment magazines, things like that. And finally, personal super contributions. They are a summary, those top 5, of allowable deductions. What I'm going to do is break it down into detail. So I'm going to start with the first one, being work-related expenses. Let's talk about work-related expenses. On the top of the list is vehicle and travel. So you can claim vehicle and travel expense if you must personally incur them as part of carrying out your work duties, and they can't be reimbursed by your employer. So if you are reimbursed, you can't claim it, obviously. That's sort of double handling. And you can't claim the cost of travelling from home to work and from work back to home. That's not tax deductible. But if you get to the office or get to work, wherever that may be, and then you have to leave and use your car to go to a client or to go to a conference or to do something for work, to go to the post office or whatever it may be, and come back to work, that leg of the trip, the to and from, is tax deductible, but not the to and from home, getting to work and coming home. That's not. There's a couple of methods that you can use to claim travel. The first one is called the logbook method. Logbook method says that you must maintain a logbook for a maximum of 12 weeks. It should be a full 12 weeks. You can use this logbook on that particular vehicle for up to 5 years. And the name of the game is to get the business percentage or the percentage that you can claim for tax purposes. So for 12 weeks, what you want to do is you want to record every bit of travel you're doing with that car, be it personal, be it for work. At the end of the 12 weeks, you obviously work out what the total is for work, for business, and you divide that by the total and you get your percentage that you can claim across the board on expenses of running that vehicle. So vehicle expenses such as fuel, oil, servicing, registration, insurance, even vehicle depreciation. All of those expenses can be claimed based on that percentage that comes from the logbook. So I'm hoping this is making sense. You only do the logbook once and once only for 12 weeks. Get that percentage. You can use that for 5 years and use that percentage across the vehicle expenses, again, which are fuel, oil, servicing, rego, insurance, even vehicle depreciation. When would you use the logbook? It's quite erroneous and requires you to keep all of the, you've got to first do the logbook and then you've got to track all the expenses, and then at the end of the year, obviously you want to claim the percentage. It may be 30, 40, whatever it is, of all of those expenses on your tax return. It's quite erroneous and long-winded. When would you use that? When you're travelling more than 5,000 kilometres a year, because the next method is called the cents per kilometre rate method. It's the simplest, easiest way. If your kilometres of travel are within the 5,000, no more than 5,000, it's the easiest way to go. Why? Because the tax office this year says it's a cents per kilometre rate. This year it's 88 cents per kilometre. So you basically have to have a diarised entry of the purpose of the travel, the amount of kilometres you've travelled, total up all those kilometres for the financial year. If it's even if it's over 6,500 kilometres, you're capped at 5. Yeah, and you may want to bite that bullet and do it anyway. You might want to do the logbook method, but it's highly likely that you're better off doing the logbook method if you're at 10 or 15,000 kilometres, because you're going to get a higher a deduction in any event. But the cents per kilometre is quite easy. Again, from a compliance point of view, diarised entry, purpose of the trip on that particular day in your diary, total amount of kilometres, total them up, multiply it by 0.88, goes into your tax return as a deduction. Easy peasy. So they're the two main types, and the distinction is whether you're travelling more than 5,000 kilometres or whether you're travelling less than 5 or up to 5. The other work-related expense is clothing, laundry and dry cleaning. You can claim the cost for buying and cleaning work clothing, provided that it falls within at least one of the following categories. It must be either occupational specific, such as doctors and nurses and things like that. It must be protective, and it must be a compulsory uniform. So I'll give you an example. As an accountant and a financial advisor, we generally dress in suits. Buying those suits are not tax deductible to me because I could wear that suit anywhere else in my normal day-to-day life, even though I only ever use it at work. If it was labelled, if it was compulsory and it had the logo of the business, I might have a better chance. But it must be, again, occupational specific, or it's got to be protective like work boots and things like that, and it must be compulsory uniform to claim that. Home office is another really good work-related one. If you've been working from home, you may have expenses that you can claim, obviously, for a tax deduction. The ATO allows you to claim using what's called a revised fixed rate method. That's quite easy. That, at this particular point in time, is 70 cents per hour of work from home. That's for the 2025 year. Now, this amount covers most expenses from working from home, and you need to keep a detailed record of how you calculated the number of hours that you're actually claiming. But again, it's like the cents per kilometre for the motor vehicle claim. It is 70 cents for work from home per hour. You can also have use the actual cost method, including a portion of your home's running costs. So the actual cost method is like telephone, electricity, internet costs, and that's based on your dedicated workspace. What does that mean? Okay, so if you've got a 20 square home and the study accounts for, 5 squares or whatever it is, you simply get the percentage, divide the 5 into the 20 squares and get that percentage, and that is the percentage that you would claim across phone, electricity, internet, also work-related equipment that you may buy. So again, 2 different methods, just depends on which way is the easiest for you to claim, but definitely a claim there. Phone and internet. If you're paying for your own phone, again, if your employer is paying for it, you can't claim it. But if you are paying for your own phone and internet connection, you can use them, and you definitely use them for work, obviously. You can claim the percentage that relates to work use, and you can obviously do that through scrutinising your bill. There is also sometimes overtime meals. If you get an overtime meal allowance as part of your employment, note any allowances are actually assessable income. So when you do get your payment statement from work, you'll have your gross amount, which goes in. You'll have the tax that's already paid, which goes in as a tax credit. If you have any allowances, they're also assessable income. So if you're putting the overtime meal in, which you will have to because it's assessable income, you want to be able to claim that. So you're not paying tax on that because it's, generally speaking, those allowances are not taxed, and therefore it will impact your tax return at the end of the financial year. So what you want to be able to do is you want to be able to claim that so you can show receipts of having used that overtime meals allowance, making sure that you're claiming that as an expense. Another one is self-education. So you can claim the cost of self-education and the costs associated with a course that leads to a formal qualification. It must be that. And it must relate directly to your current employment. It can't be something that you're looking at changing or transitioning into and starting something new. It's got to be directly related to your current employment, and it leads to formal qualifications or improvement of your current qualifications. That's that's where it falls into the parameters of self-education, being able to claim that. Obviously, you can't claim repayments for any government assistance you receive to take out courses such as higher education loans and things like that. The other work-related expense is tools and equipment. And it sounds like a bit of a tradie thing, but tools and equipment for me are like laptops and what have we got? We've got printers and, tools of trade. They're sort of my tools of trade, if you like. So if you need to buy tools and other equipment to earn your income, obviously, you can claim a deduction for all or some of the costs, depending on the percentage of work-related use and personal use. Again, you've got to make sure that you're not over-claiming. There is another section in your tax return that says other work-related expenses, and that is pertaining to 3 other things. One is income protection. Income protection insurance is exactly as it states. It protects your income. So if you get injured or you have an accident or you get ill or you get sick, you can claim this insurance that replaces lost income. Because it's replacing lost income, the premiums on this type of insurance is 100% tax deductible to you. So this is where you would claim the premiums of that type of insurance. The other one is union fees. If you're part of a union, union fees are also tax deductible in the other work-related expenses section. Usually this is listed on your group certificate as well. And then finally, any other personal costs associated with work-related seminars or workshops. So if you are going to workshops, seminars, anything to do with your current employment, you can also claim that in the other work-related expenses. So that is a summary of the first of the 5 type of expenses that I've just spoken about, which is work-related. Now I'm going to jump across to cost of managing tax affairs. We're predominantly talking about your accounting fees, obviously. So your accounting fees in relation to lodging your income tax return, whether you see a specialised accountant or whether you simply go to a H&R Block, and any BASs, anything to do with bringing your financial details into lodging an income tax return. The cost of managing that and the cost of seeing an accountant and preparing all of that is 100% tax deductible, obviously. Gifts and donations is another one. You can claim the cost of any charitable gifts or donations you make to a deductible gift recipient. You can't claim a donation if you received a personal benefit in exchange for your gift or a donation, even if it's a ticket to win a prize. Okay, so must be approved by the tax office and there must be no reciprocal arrangements there. The 4th one here is interest, dividend and other investment income deductions. So expenses associated with earning assessable interest, dividend or rent or other investment income like bank fees, interest on monies borrowed to buy shares that have provided you with dividends, or investment management fees. So investment management fees are on things like managed funds. So if you have invested in managed funds, you will receive a tax statement at the end of the financial year. It will list all the types of income that you will be assessed on as part of that managed fund. It will also list the expense management fees and any other expenses that they've deducted. You can claim that. If you've borrowed money to invest in a share portfolio, interest on that loan is tax deductible to you. One of the things most people miss is if you're subscribing to any investment channels or magazines or anything like that, you can offset the cost of that subscription with your investment income. Again, the direct nexus piece. You can't just claim that expense if you don't have any investment income such as interest received or dividends or anything else like that. And rental, obviously, from a rental point of view, you can claim all of the expenses associated with earning that income, which is rent received on residential investment properties. One thing I want to note is about prepaying expenses and interest. So expenses relating to investment activities can be prepaid each financial year. You can prepay up to 12 months, the following 12 months, before 30 June on a loan for, say, a property or share investment and claim the deduction this financial year. So let me explain that. So you're in June, you're about to clock over 30 June, which is the end of the financial year. You've been paying, let's assume you've got a loan on an investment property or you've got a loan on a share portfolio and you've been paying the expense this year. That's deductible to you, not a problem, provided it's 100% related to earning that income and none of it's private in nature. If you want to prepay the following 12 months, which means that then when that 12 months comes, you're not paying it, but you want to prepay, you can prepay the following 12 months and you can claim it before the end of the financial year because you've prepaid it before 30 June. So you're kind of getting two lots of payments in one financial year. When and why would you do this? Potentially to offset any additional income you may have received that financial year. If you have potentially sold any shares that you're holding and you've got a capital gain, or you've received some sort of a payout that's assessable, any reason for you to prepay and reduce your taxable income, there is an option there to do that as well. And this is what's called tax planning. Tax planning is incredibly important. Why? You don't want to pay any more tax than you should be. Yeah. Finally, personal super contributions. This is a big one. If you make a personal tax deductible contribution, which is called the concessional contributions to your super, up to the maximum limit of $30,000. Make sure that you are not going over the $30,000. Make sure you take off your super guarantee contributions that your employer's already put in for you, or if you're in your own business, any contributions you've made that are concessional. And so if, for example, you've already got 10 or 15,000 concessional contributions already done to date, if it's 15, you've only got another 15 to go before 30 June. Physically, you've got to have the money to do it. Obviously, benefit, well, you get more money into super, which is wealth creation. So it ticks the box. It's not frivolous money throwing away for no good reason. And you are reducing your taxable income because your allowable deductions are higher. Again, when would you use this? If you've sold some shares, if you've got a bona fide redundancy payment, and part of it is assessable, any other form of income that is coming into your tax return that particular financial year that you need to offset with further deductions. If you're looking for further deductions, super top-up is a great one. Prepaying interest is another great one as an example here. Just make sure that after the financial year, before the financial year, that you're filling out the form with a specific superannuation fund saying that your notice of intent is called a notice of intent to claim, meaning that the tax office, the super fund will notify the tax office that these deductions that they received will be claimed by the individual and therefore the super fund will tax it at 15 cents. And the tax office will match that when they receive your income tax return because there's all this income matching now. One other thing that you can use with super, so that's the concessional. The concessional is the one where you get to claim and it gets taxed on the way in. If you haven't maximised your cap for the last 5 years, so this year it was 30,000. The previous, so 21, 22 and 23 financial years and 24 financial years were 27,500. The cap, and prior to that, the 19 and the 20 financial years were 25,000. If you didn't meet the cap, so for example, last year when it was 27.5, if you only put in 17.5, you've got 10 grand last year that you did not claim that you can claim this year if you wish to do so. You can only go back 5 years. So if you do not claim the 2020 this year, that's going to drop off because it's a rolling 5 years that you can claim. The only caveat here is your super fund cannot be in excess of 500,000, the total balance. If you're over 500,000, you can't use the catch-up contributions that I'm talking about. But if you're under 500,000, you can look back 5 years if you have received a payout of some sort or massive portfolio that you've sold, or you've sold a rental property, you've got a massive capital gain, and you're just, rummaging around for how can I reduce this because I don't want to pay any more tax, you can look at maximising and you would have the cash to do this, because if you've sold a rental property or a share portfolio or got a redundancy payment, you've got the cash in your hot little hands. You can use that to offset the additional tax you're going to pay by either maxing your super this year to the max of 30 and looking at previous 5 years to see if you can max those as well. And you might say, but Trace, I can't access it. It's super, can't access it till age 60 and I'm only 52 or I'm only 45. My answer to that is, would you rather pay tax to the tax office that you're never going to see again? You got to part with the cash anyway. Maybe you should part with the cash and put it in your super. At least you see it in, 10, 12, 15 years. That's really the argument. That's what you want to be mindful of. So consider the catch-up contributions if you are eligible to do so, obviously from a super fund balance point of view. For those of you who are in a lower tax bracket, there is a government co-contribution scheme that works really, really well. Now, for the 24-25 financial year, if your taxable income is equal to or less than $45,000, if you put in $1,000, you'll get $500 back from the ATO, from the Australian Tax Office. That's 50% return on your money. That's pretty good odds, right? If your total income ranges between $45,000 and $60,400, the entitlement reduces, obviously. It's prorated. And if you're going over the $60,400, it cuts you out altogether. But for those who are under $45,000, putting in $1,000, getting $500 from the ATO is a fantastic way to go, and something you should be considering. I do want to make a point here that it's really, really important when we're talking about tax deductibility and we're talking about lodging tax returns. It's really important to make sure that you're keeping your records and that you can substantiate each and every single claim if and when you're ever audited by the ATO. Now, we are all meant to be audited at some stage in our lives. There's no guarantees of when and where that will happen, but it is always really, really important to make sure you're keeping your records, keeping them in, say, a plastic pocket of some sort, or some, these days digital formats are probably the easiest thing. I'm still very old-fashioned and love paper and quite tactile. But, make sure you keep it per financial year. Once you've lodged your tax return, make sure you're asking your accountant or your tax agent for a copy of that tax return. And a lot of the time when I say to clients, can I have a copy of your previous tax returns, they'll provide me with the notice of assessment from the Australian Tax Office. That's not a copy of your tax return. That's a notice of assessment, which is what you receive after you lodge your tax return to say, hey, this is the financial year, 30 June 2025, this was your taxable income, and it just gives you all the particular details and says this is your refund or this is your tax payable. What you want is a complete copy of the income tax return that the accountant has prepared for you, and it'll be, a certain amount of pages, and you should always file that away with your source documents and your notice of assessment, so you've got everything year by year by year. If you want to explore any part of what I've just spoken about in terms of maximising your tax, and this is a pathway that you think you want to make sure that you're maximising, and you don't want to pay any more tax, because God knows none of us want to pay any more tax than we have to, and we want to make sure that we're maximising every particular deduction that is open to us. Make sure you're booking a call with one of our strategists. All you got to do is go to our website, wowwomen.com.au, click onto our programs, and the best part is the call is absolutely free with no obligation. If you have found this episode particularly helpful, please share it with a friend and write us a review. We would love your feedback. Don't forget to subscribe so you're never missing an episode. And until next time, take control of your wealth and your future, and particularly your tax.